Okay, so navigating the stock market, right? It feels like growth stocks are always the talk of the town.
Absolutely. Those companies expected to just, shoot the lights out with expansion.
Yeah, but even inside that whole exciting space, there's this really fundamental split. And getting it wrong it can really hurt your investment depending on what the economy's actually doing.
That's a critical point. How do you figure out if a growth stock is just riding the economic waves, up when things are good, down when they're bad?
And maybe totally wiped out in a downturn.
Exactly. Versus one that seems to be on its own path, driven by something bigger than just the next few economic quarters.
And look, this isn't just fancy Wall Street talk, is it? This is stuff you really need to know if you want to be smart about where the opportunities are.
And the risks, too. Definitely the risks.
Right.
That distinction is precisely what we're going to dig into today. Cyclical growth versus secular growth stocks sounds maybe a bit complex.
A little bit, yeah.
But we're going to break it down, make it really clear what it means for you, especially if you're investing in the U.S. market. We've pulled together insights from places like The Motley Fool, Tokenist, SoFi, Investopedia.
Good sources.
Yeah, reputable ones, accounting insights too, and even some, practical takes from market folks like Jim Cramer.
Okay.
So the mission here, we want to boil all that down, give you the core nuggets so you get a clear picture of these two types, how they act differently.
And why that difference is so important for how you approach investing.
Exactly. We're aiming for those aha moments, get the key takeaways without drowning you in jargon.
Perfect. Let's give everyone a solid framework for thinking about this. So basically what we're talking about is how sensitive a company is to the big economic picture.
That's the heart of it.
Yeah.
But before we really draw that line between cyclical and secular, maybe let's just quickly define growth stock itself. What do we even mean by that, generally?
Good idea.
Based on sources like The Motley Fool, these are basically companies that everyone expects to grow their earnings, their revenue, much faster than average.
Faster than their peers, faster than the whole market.
Right. They're often the innovators, maybe shaking up old industries or creating totally new ones.
The disruptors.
That's the word. And they tend to plow their profits right back into the business, fueling that growth. R&D, marketing, expanding.
All that stuff.
So because so much of their value is tied up in future expectations, they often trade at, let's say, richer prices, higher valuation multiples.
Like PE or PS ratios being high.
Exactly. Price to earnings, price to sales.
Okay, maybe just a super quick reminder on those. PE is the share price divided by the earnings per share over the last year.
Right. Tells you how much you're paying for each dollar of current earnings.
And high PE suggests investors expect future earnings to grow a lot. PS is similar, but uses revenue instead of earnings.
Price divided by revenue per share. Often useful for growth companies that aren't profitable yet, but are bringing in a lot of cash.
Got it. So growth stocks are priced for big things to come.
Which, as Motley Fool points out, inherently makes them potentially more volatile, more swings up and down compared to, say, slower, more established companies.
Makes sense. High expectations mean bigger reactions if things don't go perfectly.
Precisely. But, as you said earlier, not all growth stocks react the same way to the economy, and that brings us to the main event. Cyclical versus secular.
Let's dive into the cyclicals first, the ones riding the waves.
Okay, cyclical stocks. Their defining feature is that their performance is really tightly tied to the economy's ups and downs, like directly linked.
Investopedia, Tokenist, SoFi, they all stress this connection.
They do. And Jim Cramer, he has this really striking phrase for them. He calls cyclicals hostages to the economy.
Hostages. Wow, that really does paint a picture, doesn't it? Like they're just along for the ride, good or bad.
It really does. Their fate is heavily reliant on what's happening outside their own walls in the broader economy.
So their stock behavior is predictable, but only relative to the economy itself.
Exactly. When the economy's humming along expansion phase, jobs are up, people feel confident, spending is strong.
Then cyclical stocks tend to do really well. Their prices rise.
Often quite significantly, yes. But the flip side is just as important. When the economy slows down, when growth stumbles, or, we hit a contraction, a recession.
Then these stocks tend to fall hard.
And often quite sharply, yes. This sensitivity makes them, by definition, highly volatile. All the sources, Investopedia, Tokenist, SoFi, they all highlight this. The price swings can be much bigger than the average stock.
Because they're mirroring the economy's swings, but maybe even amplified.
That's a good way to put it. And the reason for this roller coaster behavior, it boils down to what these companies actually sell.
Ah, right. It's about the products and services.
Exactly. Cyclical companies usually deal in stuff that's considered consumer discretionary.
Things people want but don't necessarily need.
Precisely. Things you buy when you feel good about your job, your finances, the future. But they're also the first things you cut back on when money gets tight or you feel uncertain.
Like buying a new car or that big family vacation.
Perfect examples. Or major home renovations, eating out a lot, buying luxury brands, electronics.
Okay, so if you're worried about losing your job, that trip to Europe is probably off the table.
It's likely postponed, yeah.
Yeah.
And that directly hits the revenues and profits of airlines, hotels, high-end retailers, and their stock prices reflect that sensitivity.
Got it. Cyclicals are tied to the economic mood, tied to spending on wants. So what about the other side? Secular stocks, how are they different?
Secular stocks are, well, the opposite in that key respect. They're described as being relatively unaffected, or at least much less affected by those short-term economic cycles.
So Investopedia, Tokenist, SoFi point this out.
Yes, they emphasize this sort of insulation from the immediate economic weather. Instead of moving with the quarterly GDP numbers, secular stocks tend to follow these big, powerful long-term trends.
Fundamental shifts happening over years, maybe even decades.
Exactly. Think deep, structural changes. Technology adoption, demographic shifts, major changes in how consumers behave. Accounting Insights really highlights these enduring trends as the main drivers.
So it doesn't matter as much if GDP is up or down a point this quarter, because their growth is fueled by something much bigger and longer lasting.
That's the idea. And because their growth comes from these persistent, multi-year forces, their performance tends to be much steadier through the whole economic cycle compared to cyclicals.
And the sources mention something interesting, that they can actually do better than the market during downturns.
Yes, that's a really key characteristic. They might not give you those absolutely explosive gains you might get from a hot cyclical during a boom.
But they offer stability when things get rough.
Exactly. Investopedia notes they provide a sense of safety. They might lag cyclicals when the economy is absolutely roaring, but they hold up much better when the economy falters.
And again, this links back to what they sell, right?
Does. Secular companies typically provide essential items or consumer staples.
Stuff people need pretty much no matter what.
Right. Things you can't easily cut out of your budget.
Like groceries, toilet paper, soap.
Yep. Or paying your electricity bill, your water bill. Basic utilities. And also healthcare, doctor visits, medicine.
You still need those things even in a recession.
Precisely. Budgets might get tighter, people might trade down to cheaper brands, but the underlying demand for these essentials remains relatively constant,
Which gives these companies more stable revenues and earnings.
making their stock prices less vulnerable to economic shocks.
Yeah.
And because they offer this stability, they often get called defensive stocks.
Defensive. Like they help defend your portfolio when the market's down.
That's the concept. They act like a bit of ballast, helping to steady the ship in rough economic seas.
Okay, so boiling it down. Cyclicals depend on discretionary spending tied to the economy's health. Seculars depend on essential needs or long-term trends that persist regardless.
That's the absolute core difference. One rides the economic tide, the other is moved by deeper, longer-lasting currents.
Let's talk more about that tide than the economic cycle itself. Understanding the phases seems super important, especially for cyclicals. It's their playground, or minefield.
Absolutely crucial. SoFi and Tokenist give us a good way to think about it, usually breaking it into 4 phases.
And economies are always moving through these, right? Sometimes fast, sometimes slow.
Constantly cycling, though the length of each phase varies a lot. Could be months, could be years. It typically starts with expansion.
The good times.
Growth. Yeah, the economy's growing, GDP's up, unemployment is falling, people and businesses feel optimistic, profits are generally rising. Most companies do well here.
Then comes the peak. Things kind of top out.
It's the turning point. Growth starts to slow, maybe flattens. You might see inflation pick up as demand bumps against supply. It's often tricky to know you've hit the peak until you're looking back at it.
Hindsight is 20/20 there.
Isn't it always? After the peak, you get the less fun part. Contraction.
The downturn.
The economy shrinks. GDP falls, unemployment rises, spending pulls back. If it's bad enough and lasts long enough, we call it a recession. This is where things get tough, especially for those discretionary businesses.
And finally, the trough.
Yeah.
The bottom.
Yeah, the low point. The decline slows, maybe stops. Confidence is usually terrible, but Paradoxically, the conditions are being set for the next recovery, the next expansion.
Okay, so those are the phases. How do our two stock types perform through this cycle?
It's almost textbook. Cyclical stocks absolutely love the expansion and peak phases.
Makes sense. Economy's good, people spend on wants.
Exactly. Consumers feel wealthy, secure, optimistic. They buy the cars, take the trips, upgrade the gadgets. Demand surges for these companies. Revenues go up, profits go up, stock prices follow.
And we've seen this recently, haven't we? Motley Fool mentioned how a lot of growth stocks, which often include these cyclicals, got hit hard in 2022.
Right. That was a time of economic headwinds, inflation fears, recession worries.
But then, as things looked better, or at least less bad, in 2023 and into 2024,
Many of those same stocks staged a huge comeback. A classic cyclical rebound reflecting an improving economic outlook, or at least receding fears.
that recent history really shows it clearly.
It's a perfect example. But then, during contraction and trough, it's the opposite story for cyclicals. They face enormous pressure.
Because people stop spending on the non-essentials.
Demand dries up fast, revenues collapse, profits disappear or turn negative, and stock prices can absolutely crater. They really are hostages to the downturn.
So cyclicals are boom time darlings, bust time victims. What about secular stocks through these phases?
Much different picture. Secular or non-cyclical stocks tend to be far more stable across the entire cycle.
They don't have those huge boom time surges.
Generally not to the same degree as a hot cyclical, no. Their growth is steadier, driven by those long-term trends, not the short-term economic sugar high.
But their strength really shows up when things get tough.
That's their key advantage. During contraction and trough, when cyclicals are taking a beating, secular stocks tend to hold their ground much better.
Because people still need groceries, electricity, medicine.
Exactly. Their revenues and earnings are more resilient. So they tend to outperform the market, and especially outperform cyclicals, during downturns. Investopedia puts it nicely. They offer safety when things are bad.
But maybe less excitement when things are great.
Less explosive upside compared to cyclicals in a strong boom? Yes. It's a trade-off.
Investopedia had that great example comparing Ford and Consolidated Edison, right?
Yeah.
That really nails the difference.
Oh, that's a fantastic illustration. Think back to early 2020 when COVID hit like a ton of bricks.
Total shutdown, uncertainty everywhere.
Economy slammed shut, unemployment soared. What happened to Ford's stock?
It plunged, I imagine. Nobody's rushing out to buy a car then.
Precisely. Buying a vehicle is a huge discretionary purchase. People hit the brakes on that immediately.
Yeah.
But Consolidated Edison, the utility...
People still needed power. Had to keep the lights on, heat their homes.
Exactly. Their stock price barely budged during that initial crash. Essential services mean demand is stable, insulated from that immediate economic shock.
But then, as things started to recover,
Then the story flips. Investopedia notes that as the economy reopened, fueled by stimulus checks and pent-up demand, Ford stock massively outperformed Con Ed.
showing that classic cyclical snapback.
Perfectly. That comparison just vividly shows the different DNA of these two types of companies. One's built for speed on smooth roads, the other's built for steady progress on any terrain.
That example is super helpful. And this whole relationship between the economy and stocks leads to something Jim Cramer talks about a lot, this idea of rotation.
Yes, the market rotation. This isn't just you or me tweaking our portfolios a bit.
This is the big money movement, right?
This is the big money. Institutional investors, the giant mutual funds, pension funds, hedge funds, actively shifting huge amounts of capital between different sectors and stock types.
Based on where they think the economy is going.
Exactly. It's about their forecast for the next phase. So if these big players start to worry that a slowdown or recession is on the horizon,
They sell the cyclicals.
they rotate out of the cyclicals, the ones vulnerable to the downturn, and they rotate into the secular defensive stocks, the ones they expect to hold up better. They're playing defense, trying to preserve capital.
And if they think the worst is over and recovery is coming,
They do the opposite. They rotate out of those safe havens and into the cyclicals, positioning themselves to catch the upswing and capture those potentially bigger gains during the expansion.
and Kramer's point is that because these are huge sums of money moving, it really drives the day-to-day action in the market, right? It affects prices significantly.
Absolutely. These rotations are a major force shaping which sectors lead and lag, often more so than individual company news on any given day.
And this has a big implication for the average investor, especially someone who just wants to buy good companies and hold them.
It does. Kramer specifically warns that just blindly holding on to cyclical stocks as you head into a real recession can be, well, his words were, a recipe for disaster. You could face massive losses that take years just to break even.
But on the other hand, if you're only holding defensive secular stocks during a long, strong bull market,
You might feel like you're missing the party. Your portfolio could seriously lag the overall market gains, just kind of treading water while cyclicals are potentially soaring.
so trying to time these rotations perfectly is probably impossible for most people.
Notoriously difficult, yeah. Most experts advise against trying to be a market timer.
But understanding the concept of rotation is important. It shows why a completely static buy and hold everything forever approach might be challenging, especially with cyclical stocks.
It definitely highlights the need to be aware of the economic backdrop and what it might mean for the different kinds of stocks you own. It's not about predicting the future perfectly, but about understanding the environment.
Okay, we've got the definitions, the link to the economy, the rotation. Let's get more concrete. Where do these stocks actually live? Which industries typically fall into the cyclical camp versus the secular one?
Yeah, the sources give us a pretty good map here. For cyclical sectors, you're looking for industries where spending really hinges on economic health and confidence.
The most obvious one seems to be consumer discretionary. SoFi, Tokenist, Investopedia all list this one.
That's the poster child. It's non-essential goods and services. Think retail clothing, electronics, hotels, restaurants, airlines, cruise lines, media, entertainment.
Stuff people splurge on when times are good and cut back on when they're not.
Exactly. Then you have financials. Banks, investment firms, insurance. Their fortunes are tied to interest rates, loan demand, how many people are defaulting, all very sensitive to the economic cycle.
Industrials too, right? The makers and builders.
Classic cyclicals. Manufacturing, construction, transport companies, aerospace, and definitely automakers. Demand for big-ticket items, new factories, infrastructure projects, that all slows way down when businesses and governments get cautious.
And information technology. We often think of tech as always growing, but SoFi and Tokenist flag it as often cyclical too, or having big cyclical parts.
That's a key point. While some tech is driven by secular trends, a lot of it is sensitive. Businesses might delay big software upgrades or hardware purchases in a downturn. Consumers might hold off on buying new gadgets or cut back on some digital services.
So that's where you find companies like, say, traditional car makers like Ford, but also maybe online retailers like Amazon or Shopify. Even though e-commerce itself is a long-term trend, their sales still feel the economic pinch.
Right. Or entertainment like Netflix depends on budgets. Digital advertising, Meta, Alphabet ad spending is famously cyclical. Digital payments like PayPal, less spending means fewer transactions. Even some big enterprise software companies like Salesforce, maybe fewer new big deals get signed when companies tighten their belts. It shows the nuance.
And materials, basic resources.
Also cyclical. Producers of metals, chemicals, lumber, their demand is directly linked to manufacturing and construction activity.
Now, the sources also mention some important nuances here. Tokenist said even within manufacturing, it matters what you make.
Exactly. Making equipment for food processing plants might be less cyclical than making luxury boats. And Tokenist also noted how even cyclical sectors can have weird periods, like how tech saw that unexpected boom in remote work tools during the 2020 slowdown. Context matters.
Okay, shifting gears to the non-cyclicals, the seculars. Where do they live?
These are the industries where demand is just steadier, driven by ongoing needs.
Top of the list seems to be consumer staples. Food, drinks, household necessities.
Right across the sources. Companies making or selling groceries, beverages, soap, toothpaste, cleaning supplies, stuff people buy week in, week out.
Utilities too. Power, water, gas.
Definitely. Essential services people and businesses need constantly. Especially regulated utilities, they tend to have very predictable revenues.
And healthcare pharmaceuticals.
Another core secular area. People get sick, need care, need medicine. Regardless of the economy state, demand is relatively inelastic.
Tokenist mentioned real estate can be tricky, though, not purely cyclical.
Yeah, they pointed out that while some real estate is very cyclical, think shopping malls or office buildings tied to expansion, other types might be more defensive, like hospitals or maybe certain warehouses essential for logistics.
And what about energy? That seemed a bit mixed in the sources.
It did. Investopedia put it with staples, maybe thinking about the basic need for fuel. But other sources, like Discussions Online or Tokenist looking at recent volatility, link it more to cyclicals or even higher risk categories because oil and gas prices swing wildly based on geopolitics and global demand.
So again, it shows you can't just rely on the broad sector label.
Absolutely not. You have to dig deeper. Is it an oil exploration company exposed to commodity prices? Or is it a regulated pipeline company with steady contracts?
Hmm.
Very different risk profiles, even within energy.
And this brings us right back to that idea of secular growth. Accounting Insights and Motley Fool connect those big, long-term trends, tech, demographics, consumer shifts, to specific companies experiencing growth that kind of transcends the short-term economy.
Even if they're technically in a cyclical sector.
Right, so a company might be in technology, which we said can be cyclical.
But its growth engine might be something massive and long-term, like cloud computing adoption or the AI revolution. That growth isn't just happening because the economy had a good quarter. It's happening because of a fundamental multi-decade shift.
This is where we see companies like, say, Apple or Microsoft benefiting from digital transformation and the cloud. Tesla riding the EV wave.
NVIDIA, Alphabet, Amazon, Microsoft, Salesforce pushing AI forward, Netflix benefiting from cord cutting, and the global move to streaming.
Meta, Alphabet, Amazon, again on the shift to digital ads, PayPal and digital payments, Etsy, Mercado Libre, Amazon, Shopify, and the ongoing e-commerce boom.
Exactly. For these companies, their growth story is less about the immediate economic forecast and more about the size and duration of these massive secular trends they're tapping into.
That makes them potentially less vulnerable to a single downturn than, say, a company just relying on people feeling good enough to buy a new sofa this year.
That's the essence of secular growth fueled by those deep, fundamental, lasting changes.
Okay, so we have cyclical growth, dancing with the economy, and secular growth, marching to its own long-term drumbeat. How should you, the investor, actually think about putting money into these? The strategies seem quite different.
They really are. The consensus from sources like Tokenist, SoFi, Accounting Insights is clear. Cyclicals offer that potential for really high returns, but it's heavily dependent on timing.
Getting in and out at the right moments in the cycle.
Whereas seculars offer more stability, more potential for consistent long-term growth that's less tied to predicting the next recession or boom.
Motley Fool had some good general tips for finding growth stocks overall, right? Especially relevant for spotting those secular winners.
Yeah, they suggest starting by identifying those powerful long-term trends we just talked about. E-commerce, AI, EVs, cloud, whatever they might be. Then pinpoint the companies that are really well-positioned, maybe even essential, within those trends.
And then look for the moat,
Yeah.
the competitive advantage.
Crucial, especially for secular growth. What protects this company from competitors just coming in and eating their lunch? Motley Fool gives examples like network effects. Think social media.
The more people use it, the more valuable it becomes.
Exactly. Or scale advantages like Amazon's logistics network. Or high switching costs, maybe software that's really embedded in a business's operations.
And these moats help them sustain growth, maybe even weather downturns, better than competitors without them.
That's the idea. The moat provides resilience. And finally, Motley Fool says look for companies with huge addressable markets.
A long runway for growth.
Exactly. Lots of room to keep expanding for years to come. You can use research firms like Gartner, they suggest, to get data on market size and potential.
Okay, so that's general growth finding. What about specific strategies for cyclical growth stocks?
Here, the sources are unanimous. Timing is key.
But, as we said, timing is hard. Tokenist and SoFi say the ideal is buy low, sell high, buy cyclicals when they're beaten down in the trough or early expansion, sell them when they're flying high near the peak.
Sounds simple.
If only.
Right. They immediately warn how incredibly difficult this is. You risk buying too early on a false start or getting caught in a value trap, a stock that's cheap for a very good permanent reason. Trying to perfectly time cyclicals is a high-wire act.
Huge potential reward if you nail it, but huge potential loss if you miss.
Which is why really knowing the industry is so important for cyclicals. Things can change fast. That energy sector discussion or the tech sector in COVID, it shows you need more than just a general economic view.
So, given how tough timing is, what can investors do to manage the risk with cyclicals?
Tokenist and SoFi suggest tools like dollar cost averaging or DCA.
Investing a fixed amount regularly instead of trying to pick the bottom.
Exactly. You invest, say, $100 every month, no matter the price. You end up buying more shares when the price is low, fewer when it's high. It averages out your costs and reduces the risk of putting all your money in right before a drop.
Diversification too, I assume.
Absolutely critical. Don't put everything in one cyclical stock or even one cyclical sector. Tokenist and SoFi stress mixing in non-cyclical defensive assets to cushion your portfolio. Kramer's rule of thumb, maybe no more than 20% in any single sector, seems particularly relevant here.
And managing your own emotions seems key.
Hugely important. Tokenist says you have to accept that cyclicals will swing wildly. Panic selling at the bottom is the worst thing you can do. You also still need to analyze the company itself. Even in a hot cyclical sector, there can be weak players.
Using cyclical ETFs could also help spread the risk.
Yes, Tokenist and SoFi mentioned that. Buying an ETF gives you exposure to a whole basket of cyclical stocks in a sector, reducing the company-specific risk.
Okay, now shifting to strategies for secular growth stocks. This seems less about timing the cycle.
And much more about identifying and riding those big long-term trends like accounting insights and Motley Fool emphasized.
So the focus shifts to, is this trend real and lasting? Does this company have a durable advantage?
Precisely. The strategy is finding companies powered by these long-run trends and, critically, assessing their moat. Can they sustain high growth over time? Dr. Preston Cherry, quoted in Motley Fool, stressed looking for that unique business service or product that provides a valuable moat. That's what protects their growth engine.
But secular growth isn't risk-free either, right?
Yeah.
Especially if they're trading at sky-high prices.
Absolutely. That's a major risk highlighted by Motley Fool and experts like Dr. Scott Stewart. If a stock has a really high PE or PS, the market is already baking in huge growth expectations.
Pricing imperfection, basically.
Pretty much. And if that growth disappoints for any reason, the trend slows, competition heats up, the company stumbles, the stock price can get hammered as those expectations deflate.
And they're also sensitive to things like inflation. You mentioned that connection to discount rates.
Yes, that's a key vulnerability for stocks valued heavily on distant future earnings. When inflation or interest rates rise, the discount rate used to value those future earnings goes up.
Making future money worth less today.
Exactly. And since secular growth companies often derive a large portion of their valuation from earnings expected many years down the road, a higher discount rate hits their present value harder than companies with strong current earnings. That's why rising rates can be particularly tough on them.
Got it. The further out the payoff, the more rising rates hurt its current value.
Well put. And like with cyclicals, ETFs can offer diversified exposure here too. Funds focused on broad growth, or specific secular themes like AI or cloud computing. Motley Fool mentioned the Vanguard Small Cap Growth ETF, VBK, as one example targeting growth in smaller companies.
So the strategy for secular growth is less about timing, more about deep analysis. Understanding the trend, the moat, the management, and crucially, the valuation. Is the current price reasonable given the realistic long-term prospects?
Exactly. It's about conviction in the long-term story, but also being careful not to overpay for that story.
Okay, we've woven risks in throughout, but let's just clearly summarize the big ones for each type based on the sources.
For cyclical stocks, the main risks, according to Tokenist and Investopedia, are definitely high volatility, those big, potentially gut-wrenching price swings.
The difficulty and danger of market timing getting it wrong is easy and costly.
They require active monitoring, generally not great for passive, set-and-forget investing, especially through downturns.
And the clear potential for significant losses during recessions.
Yeah, those are the big cyclical headaches.
And for growth stocks in general, including those high-flying secular ones.
Motley Fool highlights general volatility, sensitivity to macro factors like inflation and rates, especially for high PE stocks and supply chains, and vulnerability to shifts in overall market sentiment. If investors get spooked about growth, generally, these stocks can suffer.
And Dr. Cherry and Motley Fool argued growth stocks are just inherently riskier than value stocks.
He did. His points were they're often earlier stage, less proven, reinvesting everything, so maybe no profits or dividends for cushion, leading to more price volatility when risks emerge.
But he also said that higher risk comes with the potential for higher returns if they succeed.
Right. It's that risk-reward trade-off. And Dr. Scott Stewart added that interesting angle based on empirical evidence.
The idea that companies with stable earnings justify higher valuations because they're seen as less risky.
But then he presented a data suggesting that, over the very long haul, high-growth stocks, the glamour stocks with high PEs, have actually tended to underperform low-growth value stocks.
That's pretty counterintuitive. Why would that happen?
His theory, and it's a common one, is that investors consistently overestimate how long these companies can sustain super high growth rates. They get excited, bid the price up based on unrealistic long-term projections.
And when growth inevitably slows down.
The stocks disappoint those lofty expectations, and the price corrects downwards, sometimes severely. Value stocks, starting with lower expectations, might have an easier bar to clear, or benefit more from just surviving and recovering.
So the risk with a popular secular growth stock isn't just market swings. It's the risk that you're paying a price based on hype that the company ultimately can't live up to,
Exactly. Dr. Stewart framed the challenge for growth investors as picking the rare companies whose earnings growth doesn't disappoint long term, a tough task.
which contrasts with a value investor maybe trying to find diamonds in the rough that won't just, well, fail. Different challenging.
Different skill sets, different risks.
Wow. Okay. We have covered a lot of ground here. Let's try to wrap this up.
Okay, so the bottom line, cyclical versus secular growth. The fundamental difference is that connection to the short-term economic cycle.
Cyclicals are tied to it up in booms, down in busts, driven by spending on wants.
Seculars are driven by those big long-term trends, tech, demographics, behavior, offering more stability, potentially more consistent growth, often tied to needs or major innovations.
And both can be growth stocks aiming high, but their sensitivity to the economy is the crucial dividing line you need to grasp.
And knowing this isn't just theory, it's practical. It helps you make smarter investment choices, manage your portfolio's risk, and tailor your strategy.
Helps you anticipate how different stocks might react in different economic weather. Maybe helps you avoid stepping on landmines.
Exactly. It's about aligning your investments with your own goals, your tolerance for risk, your time frame, and yeah, even your view on where the economy might be heading.
Ride the waves or follow the deep currents.
It's a key question to ask yourself. It really provides a vital lens for looking at the market.
So, thinking about everything we've discussed, the difficulty of timing cyclicals, the risk of secular stocks being priced for a future that might not happen, especially with that data Dr. Stewart shared about value maybe winning out long term. Here's a final thought to chew on.
Does trying to build a portfolio by deliberately mixing both types of growth stocks, maybe shifting the balance based on your economic outlook, actually offer the best way to manage risk and capture potential returns today?
Or is that long-term data the biggest takeaway? Is chasing high growth just too prone to disappointment over decades? Should the focus be elsewhere?
Or maybe, in a world being so fundamentally reshaped by rapid tech changes and demographic shifts, those huge secular forces, how much do the old cyclical rules even apply anymore to the most innovative companies?
Yeah, are they still hostages in the same way? Does the real deep dive analysis now need to focus less on the next GDP report and more on figuring out which secular trends are truly unstoppable and which companies have the real durable moats to win?
Those are the kinds of complex, interconnected questions you start asking when you really dig into this stuff.
Definitely plenty to think about there. Different paths for growth, different risks, different rewards.